All right. Hi guys. This is Trade UK, and I'll be giving a quick analysis on GBPUSD, how to analyze, how to go about it, basically chart work, what to look out for, and my perspective on the market and how I trade. All right. So this is going to be a top-down analysis. Let's go to the 1 week. Let's go to the weekly time frame. Yeah. So from the weekly time frame, what can we see? We have two trends going on here. We have major trend and minor trend. What's the major trend? Yeah, the major trend is the buy, obviously, like you can see. What's the minor trend? The minor trend is the sell. All right. So what are we working with? We're working with the sell. Now this is a fair value gap here. I trade fair value gaps just for. I mean, this video is not for the newbies. It's for at least beginner traders that have little experience in forex trading, for them to understand this video better and how to analyze properly. So what can we see here? The market was going up, higher highs, higher lows, higher highs, higher lows, higher high, clearing this high. Now the market has taken out this low. So this is clearly a reversal. Clearly a reversal. So what are we going to be looking out for? Looking out for a pullback before the continuation of this sell. All right, so now we know what we're looking for. Now we know what we're looking for. We'll scale down to the lower time frame. Let's go to 4 hours. Let's go to 4 hours. First of all, we identify your trend. That's the first thing. We've identified the trend. The major trend is the buy, but the minor trend is the sell. So we're basing on, because I'm a day trader, we are day traders, you know, so we're concerned about what's going on in the markets right now. So we've identified the current trend as a sell. So what are we looking out for? First, you mark your highs. First, you mark your highs, and you mark your lows. Yeah, you mark your lows. All right. So after doing this, you've marked out your highs and your lows. So we already know what we're looking out for. Now is the sell market that's taking out this low. Market that's taking out previous lows. So what are we looking out for? Next thing, after marking your highs and your lows, the next thing you're looking out for is a fair value gap. What's a fair value gap? A fair value gap is basically the second candle in a three candle formation. Yeah, the second candle in a three candle formation. That's a fair value gap. So it's basically something like this. This Let me draw it for you so you can understand. Something like this. Yes, something like this. So this is basically what a fair value gap is. You know, this here is what a fair value gap is. A three candle formation, the second candle, that's the middle candle, you know, whereby the wick of this first candle and the last candle, they do not overlap. So this space in between here, this space in between here is called a fair value gap. So that's what I trade. So look for fair value gaps around here. Let's look for some examples. Let's look for some examples of fair value gaps so you can just understand what I'm talking about. All right, something like this, something like this. Perfect. This is perfect. This is a fair value gap because this is, if we expand this, this is your first candle, this is your second candle, and this is your third candle. So when this week doesn't overlap with this week, the space in this candle, this space is called the fair value gap. This space is called the fair value gap. That's what the fair value gap is. And if you keep looking, you see more examples of different fair value gaps. You know, here, this is a fair value gap here, right here. This is a fair value gap. What else? What else? This is also a fair value gap. Mind you, we're in the business of making money here. So, I mean, as a professional trader, you understand that not every trade you take, you're going to win. But what makes you come on top is your ability to, come out profitable at the end of the day after several trades and whatnot. Is a fair value gap here. So if you keep backtesting and looking at your chart over time, you get conversant with it, and it's easy for you to spot. So that's it. All right. So what next after marking out your highs and lows? You go ahead to look at fair value gap. So let's go to the 1 hour time frame. Let's see what we have on the 1 hour time frame. Perfect. This is awesome. So first thing first, we have this fair value gap here. We have this fair value gap here on the 1 hour. We have another fair value gap here. You may be asking, all right, so Mr. K, why isn't this a fair value gap? Why is this level not a fair value gap? Why don't I call this a fair value gap? Some people do, call it a fair value gap, but I don't. I trade valid fair value gaps. There are invalid ones, yes, and there are valid fair value gaps. There are valid fair value gaps and there are invalid fair value gaps. So how do you identify a valid fair value gap? It's very simple. Now, this is, to me, this would be identified as a breakaway gap. The valid fair value gap is one which the last candle, the third candle, that's this candle, and this one right here, this one right here. Yes, that's the first candle. This is the second candle right here. That's the second candle right there. And this is the third candle right here. And this is the third candle right here. Sorry. And that's the third candle right there. So what makes it valid? The third candle doesn't close below the second candle's wick. So no matter how much of a movement this third candle wants to make, it's going to close below, inside. It's going to close inside of this one, but the wick is not going to overlap with this one. So this wick must not come here, and this candle must not close below this second candle. Do you understand? We look for more examples of valid fair value gaps. This is a valid fair value gap right here. This is a valid fair value gap right here. Yes. Where the first candle keeps its wick, the second candle makes the big move. The third candle doesn't body close below the second candle. The wick, the wick overlapped, but the candle itself, the body closed inside of the second candle. That's a valid fair value gap. You see. So that's basically how I trade. And this is the consequent encroachment. So if I was to trade this, definitely I'll pull this out. If I was to trade this would have been the sell right from here. This would have been the sell right from here. If I was to trade this market. You understand? If I was to trade this would have been the sell right from here. Aiming for this low. Aiming for this low. To take out that low. And my stop loss would have been above there. If I was to trade that, yeah. But on the lower time frame, I'll get a better entry, with a better risk reward. But let's go back to, so that's just differentiating uh, valid fair value gaps and invalid fair value gaps. Invalid fair value gaps, for instance, this one, where the first candle, the second candle, and the third candle, you see. So this is the third candle, this is the second candle, and this is the first candle. Now the first candle is fine, the second candle is fine, but the third candle is making a big move. He's supposed to come up a bit, dance and play around here, but not close below the second candle's low. So this is a breakaway gap. So I cannot consider this space here a valid fair value gap. Doesn't mean markets can come here and trade off it. Of course, markets can come here and reverse, but it is not valid. You don't expect market to come back there. It can come back there, but you don't expect it. You understand? So this is the one you expect market to come to and come down for a sale. And this also, why I'm even considering this a fair value gap is because the market did not close with a week on this last candle, and it didn't close much below this below this second candle, and it's already giving us a reversal pattern right here. So I don't expect the market to come here. I don't expect the market to come here and sell. I don't expect that to happen. Basically, what I'm looking for to happen is this. I'm expecting the market to come here, you know, disrespect this fair value gap, retest it, give me a confirmation for a buy. But I won't buy because I'm not in the business of, trading to my entry. No, I just wait it out till it gets to my point of interest. So I'll be expecting the market to come here, and when it comes into this zone, right from this fair value gap, this middle line is called the consequent encroachment. That's the 50% level of your fair value gap. So I'm expecting the market to come somewhere around here, and give me my entry pattern and confluences, entry confirmation rather, for a sell. So this is basically what I'm looking for on GBPUSD, um, 1 hour time frame. So this is what my chart is going to be looking like tomorrow, Wednesday or Thursday, hopefully, depending on when the market gets there. So this is basically what I'm looking for. The moment market disrespects this fair value gap here and retests and starts coming up, this is a strong confirmation for a buy. This is a value fair value gap. So what are my confluences at the end of the day? Number one, we have a trend sell. Number two, value fair value gap or higher time frame. Number three, uh, my entry confirmation when it gets to this point. I'm either entering with market structure shift or change the state of delivery, which are two different entry models I use when taking my trades. So that's basically all on GBPUSD. So I hope with this video, I know it's not that deep, it's quite me scratching the surface, but I'll probably drop a video explaining in details like a proper course. I mean, it's going to be for free, where you can watch and actually learn from scratch how to properly analyze. Or it's very, very simple. First step, identify your trend. Second step, mark out your highs and lows, which you're going to use as your drawn liquidity. That's where you identify your take profits and your stop loss. Then your those are called your ERLs, external range liquidity. Your IRLs, your internal range liquidity, is basically your fair value gaps. Your fair value gaps. These are your IRLs. These are your ERLs. You understand? So that's basically it. And once you're done identifying that, you're good to go. Wait for your market to come to your point of interest and choose any entry model of your choice and set and forget. It's basically simple. Thank you. Trading with K here. I hope you enjoyed this video. See you next one. Bye.